even though bank loans are at 35%, there are people who prefer to take a bank loan at 35%. And let me give you examples of industries like that. You see the microfinance banks. Microfinance banks and many of these fintechs that give loans. All these fintech companies, all these mobile apps that give loans. Many of them give out loans at 5% interest per month. 5% interest per month. If you annualize that interest, it comes to 60% per year. So most microfinance banks and fintech companies are giving out loans at 60% per year. Guess what they do? They borrow money from banks, some banks at 30%, 35%, and they give away loans at 60%. For a microfinance bank, at 30%, the loan is cheap. And it's not just microfinance banks. You have cooperatives that are doing this, giving out loans to their members. You have all sorts of organizations that give short-term loans. So any business that is into short-term loans, you give loans of 30 days, 60 days, and you're giving those loans at 5% interest, 6% interest. Getting a loan at 30% per year is a sweet deal because it comes to 2.5% a month. You are getting money at 2.5% a month and you are giving it out at 6% or 5%. That's almost double. So these guys are in love with bank loans. I'm saying this because Francis said in his comments that 30% interest is not workable. I'm just giving you an example of industries that are benefiting a lot from bank loans. Another example are the retailers, so supermarkets. So because they sell fast-moving consumer goods, they buy and sell items, whether it is milk, toothpaste, tissue paper, soap, cosmetic products. These are things that people consume on a daily basis. So a supermarket can take a loan at 30% for a year and turn over that business such that at the end of the day, if you calculate the returns on that 30%, they may make above 100% on that same loan within a year because of the high turnover of their business, right? So that is another example of a business that even though bank loans are expensive at 30-35%, the retail industry, particularly the ones that deal in fast-moving consumer goods, they still love bank loans because from their own perspective, bank loans are still cheap at 35%. I'll give you another example. Importers, you are bringing in products that have guaranteed sales. For example, the guys who import spare parts. The moment spare parts, okay, so we have somebody who runs a cooperative and she's confirming what I just told you. If you are giving out loans at 6%, why will you not take a bank loan, which is 2.5% a month? It's a sweet deal. You're making almost 100% on a return on it, right? So, if you are into imports, but for example, spare parts, the moment your container lands, you have people that will buy off the stock. So it makes sense to take a loan at 30% for a year. You buy your goods from China or wherever. It takes about 3 months to reach West Africa, Nigeria. You sell. Within 3 months, you've turned over the money and you've made your return. So 30% may look big, but it's not big for you, for your kind of. So what I tell people is that don't generalize. Don't say bank loans are expensive. They're not expensive for everybody. For some kinds of businesses, it doesn't make any sense to touch a bank loan at 30%. It's going to kill your business. So what it means is that you need to know what your turnover rate is, and you need to know what your operating margin is, your operating profit. You need to know what the margin is. If not, if you touch a bank loan, it can get you into serious trouble. So it is relative. It all depends on your business and the kind of business that you run.